Hello and welcome to the first episode of our brand new series, Credit Academy. Now, the purpose of this series is over the course of maybe the next year or so, we're going to be giving you tips and a stepwise motion to build credit, not only just from scratch, but also if you're in need of credit repair and kind of tips you can do to help repair your credit as well. So, credit, let's face it, is a very complicated and convoluted topic at times. And at the end of the day, there's a lot of different resources telling you a lot of different ways you can build and repair your own credit. So once again, kind of the purpose of this is that you have an all-in-one kind of course package here that is completely free for you to be able to get tips and help with building your own credit and also repairing your own credit. So in today's episode specifically, we're just going to kind of outline some of the common misconceptions when it comes to credit and credit repair and outline the course as a whole as well. So let's go ahead and jump on into this. A quick little disclaimer before we jump on into things. While we will give you information to help, build up your credit as well as repair your credit, we in no way can guarantee results. This is all going to be done by you as an individual. And if you're looking for, kind of outside help as well, or somebody to step in and help you with your credit, we highly recommend hiring a company like us, the credit agents, to step in and help you out as well. So the purpose of this course is purely educational. So once again, we cannot guarantee any results, but we can get you on the right track and give you some good credit building and repairing habits so that you can try to maximize your credit score while going through this course. So starting off with misconception number one, credit is impossible if you don't already have it. This is just outright not true. I mean, let's face it, if you had to have credit in order to build credit, none of us would have credit. Everybody has to start from somewhere. So there are definitely kind of systems in place that you can look forward to, like, secured credit cards, credit builder loans, as well as becoming an authorized user. Now, we're going to dive into each of these kind of three ways to build credit in some of our future videos, but we just wanted to say that these are some brief overviews of how you can get started in building credit in a very kind of risk-free way as well. So misconception number two is going to be once a credit score is bad, it can never be rebuilt. This just isn't true because there wouldn't be companies like us, the credit agents, there to help rebuild credit for you. In addition to that, there are ways that you can repair credit yourself, which we'll dive into a little bit further on into this series. But a bad credit score doesn't have to be permanent. With a little bit of determination from you and consistency in sticking with it, you're going to be able to get your credit score back up. Common misconception number three is checking your own credit score can lower it. This, once again, is not true because if you've seen our soft versus hard inquiry video, you'll know that checking your own credit score counts as a soft inquiry. This, under no circumstances, will ever lower your credit score. On the other hand, when you're applying for brand new lines of credit and a lender runs a check on your credit score, this is known as a hard inquiry. And this is where if you apply for too many lines of credit in too short of an amount of time, they can stack up and lower your credit score. So the one major thing to take away from this is as long as you are checking your own credit score for personal reasons, it will never lower the score itself. Common misconception number four is that there is only one singular type of credit score that is used whenever lenders check your creditworthiness. If you've been following us for a long time, you may remember the differences and the videos we talked about between FICO and Vantage scoring models. Those are kind of the two major scoring models, but even within those two primary scoring models, there are going to be iterations and versions, each with their own scoring type itself. So in reality, you could have over 15 separate credit scores, and that is why we highly recommend that you check the most popular scoring iterations when it comes to checking your own credit score. You never want to base your own credit score off of only one type of scoring model because both FICO and Vantage and within their variations can be large deviations between the credit scores themselves. Common misconception number 5 is going to be your credit report from each of the 3 major credit bureaus is going to be exactly the same. Now, I kind of briefly covered this in the last common misconception, but this is not going to be true. Not only do the three major credit bureaus look at different types of scoring models, but also the type of things that get reported by the lenders themselves are going to be different as well. So say each of the three major credit bureaus are giving you the same FICO scoring iteration. Well, sometimes Experian versus TransUnion could have a different score just because the lender of, say, your credit card chose to report to only one of those two instead of all three. So in reality, you can have drastically different scores, which is why, once again, we recommend to check all of your credit scores if possible. Common misconception number 6 is paying off all of your loans and lines of credit before the original due date will actually raise your credit score. Well, this isn't exactly true. And the reason for this is because there is a section on your credit report known as length of credit history. Now, this section takes into account the length you've had all of your lines of credit. And this is why in some cases, if somebody, say, pays off their auto loan or mortgage early, their credit score can actually go down. And that is because it is no longer reported on the credit report, overall lowering the average kind of score of that category. Common misconception number 7 is good credit is dictated by the amount of money you have available in the bank. This, once again, is not true. Your credit does not scale at all to your income you have readily available. Now, hypothetically, if an individual makes $100,000 a year, but they're constantly maxing out their credit cards and banking statements, they would have a significantly lower score than an individual who has half of that salary, but makes their payments on time, as well as doing less than 30% of their total available credit for their credit cards. This is because there is an entire section dedicated to labeling you as higher risk. Oftentimes, having that kind of credit limit increase will encourage you to spend more, but it doesn't necessarily mean you should be spending more. Oftentimes, you don't want to go anywhere near that credit limit because, once again, that considers you as higher risk. You want to try to stay within 1 to 7% of your quote-unquote utilization rate if you can at all possible. If that isn't possible for you, you want to try to keep below 20 or 30%. Going above that is where you start to risk a little bit, but the reason I say 1 to 7% is optimal is because you can actually get a pretty decent score benefit from keeping your credit utilization rate within that range. All in all, there are a lot more misconceptions than just these 7. However, we want to save a couple of the other misconceptions for future videos as well. And remember, we're going to be diving into each of these misconceptions in more detail in future videos. So make sure to stick around and hit that like, subscribe, and bell icon to stay up to date for when a new episode of Credit Academy goes live. And my name is Michael. Thank you guys so much for tuning on in, and we hope to see you in the next one.